Welcome to the National Credit Awareness and Resolution Association podcast at ncara.org. That's NCARA.org. Your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use Creditor Tools, namely the industry and business risk analysis. NCARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Creditors generally are aware of the key industry and business risks as part of the underwriting process. Creditors also have ongoing credit risk management practices that include close monitoring and will understand the risks facing their customers and most businesses in the industries they lend money in. They know how well business owners can and should manage those risks. Creditors constantly seek to see how their clients distinguish themselves from the competition. After all, customer acquisition is limited and keen, especially in an economic downturn. A close look at the products and services will be made to see whether there are any advantages a company has in the marketplace. Other business risks include a company's suppliers, the production and distribution processes, as well as the sales process. How big is the company in terms of sales, assets, profits, and market share, and what stage of maturity is it at currently? Every business has a life to it, just like the natural person who is born and later dies. Key risks include the maturity of the industry itself, technology advances, where industry sits in the current economic cycle, the costs of products, competition, operating conditions, regulatory oversight or burden, and how profitable companies have been in the past as well as projections for the future. The words dynamic and fragile easily come to mind. No wonder lenders have ongoing credit risk management controls for their loans or their asset quality. One major business risk factor is the company's management team or their key leadership, and whether there is a reputation of integrity out there in the marketplace. Does management have the experience, the knowledge, and background to steer the company at the present time during an economic downturn? Is there a strategic plan in place that is performing to plan? These are all questions that the creditor will seek to understand to determine the overall viability of a given company. So why is this important to you? Pay attention to keep passing upstream your business and industry risks. Whether you're talking about loan origination or at a loan modification of a seasoned lending relationship, you have an important responsibility in shaping the creditor's understanding of your business and industry risks that you're currently experiencing. This is part of you taking primary responsibility for creating your own debt repayment solutions, especially if you're experiencing financial trouble. So this is not a scenario where you assume the creditor truly understands your business risks or industry. The creditor is supposed to know your business and industry, but assumptions are not where you want to go with this, especially in an economic downturn with financial difficulties. Creditors are represented by individual people who are always in learning mode themselves. There's also turnover, needed training or lack of training, personnel shortages, and inexperienced workout officers. They just don't know. Of course, there are people who may have experience in the industry, but those people may be far removed from the actual primary relationship officer responsible for working out a repayment plan for your business. So, what are you to do? Whatever you do, don't assume. First, you level set the playing field. The creditor wants and needs to understand your points of view, the business risks you are experiencing or will soon experience. The same goes for the industry risks too. Again, do not assume the creditor already knows what is happening to you specifically or what you may be talking about, even if you've had a long-term relationship. Just don't assume. It is possible, even likely, he may be less knowledgeable and prepared to represent your interests at the bank or the lender than you currently think. Do not take it for granted. When business and industry risks change, and they do and they will, this is new territory, and you need to fully explain these risks and document them. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune into the the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore critical risks that could trigger a downturn and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness around these risks. Subscribe now to stay informed and be ready for whatever comes next. If you're experiencing material underperformance, your account relationship may in fact be transferred to an officer in the Special Assets Department, commonly known as SAD, SAD, or a workout department. Approach any new credit officer, probably a workout specialist, from the start by supposing this individual is not all that familiar with your business or industry risks. So be patient. Prepare, like I said, a well-documented analysis and summary of the business and industry risks you face and how it's affecting your operations. Remember, the new credit officer may not have anywhere close of an understanding as would others in the institution. Second, you should literally present in writing your business risks and industry risks. How do you convey business and industry risks? Besides documenting the risks, be sure to ask questions to the credit officer to make sure he knows what you're trying to convey. Have a real two-way conversation. There can be no misunderstanding here. This is critical for your survival. Spell it out and give plenty of context. You need to give your credit officer the why behind your repayment plan and the understanding of what you're experiencing that affects your operations and cash flow. You need to know that he gets it. Persist until he does. This is your business you're fighting for, so be very, very clear. You will not regret it. Aside from making poor management decisions, if you can convey these risks, they will serve as the backdrop, the foundation, the why to any proposed workout plan. You will recommend, as evidenced by your financial statements and especially the pro forma cash flow statement, a solution to your own debt repayment plan, and these risks are part of that plan. The primary focus will be on the pro forma cash flow statement, showing the lender what repayments he can expect to receive over the next year or so. The written explanation of your current business and industry risk will support the forecasted repayment numbers. Finally, give the creditor the answers to the test before he prepares the credit approval memo. The picture you paint of your business and industry risk will also be used by the credit officer as part of the credit approval memo to approve your workout plan. If your information is well prepared and credible, you will make the job so much easier. If it makes sense to you or to an independent third party, it will make sense to the creditor too. If you can stand behind the risks, if you understand them, put it all in writing and expect that your risk explanations will be acceptable. Creditors put a lot of weight on the information you will provide them. If the creditor doesn't ask for all these risks, give them anyway, so his understanding is genuine and up to date. When circumstances change, let the creditor know those changes too. Thank you for joining us today. We covered the Creditor Tool, industry and business risks, as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at NACARA.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, Step forward and take responsibility for your own debt repayment solutions. Thanks again.